Hey guys, so in this first part of Digital Greed, I'm going to be talking about the difference between investing, speculating, and gambling. These aren't any dictionary defined terms. Mine are a little bit different, but I think that they have helped me in my own personal trading. So, let's. What kind of things do you guys think are investing, speculating, and gambling? We can think of investing as something maybe safer, so like an index fund, maybe by Berkshire Hathaway, run by Warren Buffett, maybe some sort of a bond fund. A lot of people think these are kind of the safe things. You buy them and hold them for the long term. Speculating, riskier, maybe penny stocks, some cryptocurrencies. A lot of people would probably put all of cryptocurrency under speculating. And then gambling, maybe like a casino or sports betting or betting on a horse race, something like that. So those are kind of the three main general categories of how kind of most people would define them. Now I'm going to define these a little bit more rigorously. What does it mean when I say something's investing or speculating or gambling? And my definitions, again, they're not what everyone else uses, but they're just kind of what I use. So my definitions kind of rely on this idea of expected value, which expected value is the mathematical expected return based on like how much you'd win or lose in a trade and the probabilities of winning and losing. So this does get a little bit into math, but it's not too hard. This first example, if you flip a coin, let's say you win $100 if it lands on heads, lose $100 if it's on tails. So in the long run, if you were to play this game over and over and over again, you'd expect to win as much as you lose, so your expected value there is $0. 50% chance of winning 100, 50% chance of losing $100. Overall, your expected value is 0. Now for this next example, let's say you win $100 if it lands on heads, or you lose $200 if you land on tails. Now, clearly you wouldn't want to take this bet because if you lose, you have to pay twice as much as you gain if you win. In this case, the expected value is negative $50, and you get that by taking $100 is your win times 50% chance of getting heads, so that's $50, and then if you lose $200 if it's tails, so 50% times $200 is a minus $100. So $50 minus $100 is negative $50 of expected value. So if you played that game over and over and over, in the long run, you're expected to lose roughly $50 per flip a coin. Now, in this last example is the opposite. So now you're winning $200 if you flip it to heads, and you lose $100 if it's tails. So in that last example, it's pretty clear that you probably would want to play that game over and over and over because you're winning twice as much as what you lost if you lose. So in that last case, it's the exact same scenario as in 2, but in reverse, and your expected value is $50. So ideally, all of your trades will look something more like that last example than the previous two. The first one isn't horrible, but if you're trading and it's kind of a wash, you're up some, you lose some, overall even, well, you still lost all that time you spent finding your trades and executing them and watching the market. So really you want to stay with ones that look more like that last one. Now with trading, it's extremely difficult to define your wins and losses to an extent like this, and then even harder to figure out the probabilities of winning and losing. So those are the hard parts to figure out in trading, but kind of the general idea is that you want to be thinking in terms of expected value when making a trade. Now let's look at a couple more examples. So let's say this when rolling a die. In this first option, each column's a different, let's call it like a payout. So option A, if you roll a 1, 2, 3, or 4, you win $5. If you roll a 5 or a 6, nothing happens. You don't pay anything, you don't lose, you don't earn anything. In that case, you might as well just keep playing that game because 2/3 of the time, 4 out of 6, two-thirds of the time you're going to be making $5, and the other 1/3 of the time you lose nothing. So that would be a very good game to keep playing if anyone ever offers you a game like that. Option number B, In this case, you can lose money. If you roll a 2 or a 3, you lose money. A 4, 5, or 6, nothing happens. But if you roll a 1, you earn $100. So in this case, the probability of losing money is actually twice as high as the probability of making money. But because earning $100 is so much more than losing $10, I would definitely be willing to play this option B, because that 1 out of 6 times you'll earn 100, that more than makes up for the 2 out of 6 or 1/3 chance of losing $10. So that would be more of a speculative position. It's riskier because you're winning less and there is a chance of loss, but overall the expected value of that is positive, even though the chance of winning is less than the chance of losing. Option C is kind of the reverse of that. If you roll a 1, 2, 3, 4, or 5, you win $5, which it sounds good. You have a 5 out of 6 chance of winning money. But if you roll a 6, now you lose $30. And that $30 loss is enough to make it so that is not a game that you should play over the long term, because that $30 loss is going to negate all the $5 wins. So that's more of a gamble. You don't want to necessarily play a game like that. Now, option D is even worse. Roll a 1, 2, 3, or 4, you win $5. A 5 or a 6, and you lose $20. That's another one that you probably would not want to play too many times, because the expected value of that is negative. And now option E, you roll a 1, 2, 3, 4, or 5, and you make $100, or a 6 and you lose $300. So this one is the case where the expected value is positive. If you did the math, you should, if you played that game a lot, end up making money. But the issue with this one is that, let's say you're in a position where you can't lose $300. Maybe you don't even have $300 to lose. It would be bad to play this game in that situation, because on the off chance you lose money, you lose everything and you can't recover. So that's the other thing with these expected values, is that even if it is positive, you might not want to play it if you have to risk too much money to play it. Now, if $300 doesn't sound like too much for you, maybe add some more zeros to that. So let's say roll 1, 2, 3, 4, and 5, or 6, where maybe you make $10,000, but roll 6, you lose $30,000. Even though the odds are kind of on your favor, if you can't afford to lose $30,000, that's a chance, and you should probably avoid making that trade, even though it's on your side. So sizing trades is just as important as these expected values. So here are my personal definitions. My personal definition of investing is when you have a positive expected value, so the numbers look good, and a greater than 50% chance of profit. So that would be like option A here, where your expected value is positive and the probability of making money is greater than 50%. Now, when you go to speculating, positive expected value still, but you might have this less than 50% chance of profit. So that would be like option B here, where you have only a 1 out of 6 chance of actually making money, so that the probability of profiting is much less than 50%, but the expected value is still positive. So you could make a lot of these trades and in the long run be up, even though your probability of making money is less than 50%. And then for this last definition, gambling, anything with a negative expected value I consider a gamble. Doesn't matter what your chance of profit is. So that's like option D here, or C. You actually have a greater than 50% chance of making money, $5 each for both of those, but the losses on the times where you don't make money outweigh your gains. So your expected value is actually negative. So even if you're making money 5 out of 6 times, if the time where you lose money outweighs those other options where times where you make money, still I would definitely not make those trades, and I would consider that more of a gamble. So just my personal definitions. You don't have to adopt any of them, but that's just kind of how I'm thinking when I make a trade. Is this more of an investment? Is it more of a speculative trade? Or is it a gamble, in which case I want to stay away from? Personally, I love making speculative trades where the odds seem against you or they are against you, but on the off chance you make money, that profit can be rather high. And I found that a lot of times in cryptocurrency, you can find trades that fit that definition of a speculative trade, where there's an outsized chance for enormous returns, and there's a substantial chance for a small loss. So you have to weigh those. A lot of my trades probably would fit more under the investing category as well. And a last bit of knowledge for this, in my opinion, many speculators think they are investors and many gamblers think they are speculators. So with that, an example of that first one would be people who are taking a lot of more speculative trades where they're hoping for that 1 in 10 chance they make a lot of money. A lot of those people think they're investors and that they're hoping that they think they might all go up because of that. And they're looking at, you can make perfectly good speculative trades, but maybe only like 3 or 4 of them actually play out how you hope they are. And you might look at that win percentage. You're like, why am I only winning 30 or 40% of my trades? I must be doing something wrong. Well, if you're trying to speculate and you're looking for these high risk, high reward things, that might be perfectly fine. So you just have to recognize that and not be dissuaded by the low percentage, your win percentage. So that's kind of one danger you can fall into, doing everything right as a speculator, but looking at the wrong metrics and thinking that you're doing something wrong. And then the other one is gamblers thinking they're speculators. If you just take wild, crazy risks, it doesn't, that the possible reward might not automatically make up for that risk. So you could go to the casino and play a lot of slot machines. Your risk is high, but the reward does not adequately compensate for that risk. So a lot of people who are trying to take these high risk, high reward bets might not be considering the downside, and they fall more into the gambling section than the speculating section. So my advice would be to try to figure out where each of your trades are. Try to avoid everything that is a gamble, which in this sense means a negative expected value. Speculating is fine as long as you recognize what you are doing and that your win percentage might be low and that you are looking for outsized returns on the ones that do pay off. And if you want to be more of an investor, you're probably looking at the returns might not be so outsized, but you want kind of one that's more guaranteed to return a profit. So just understand what you're trying to get yourself into and what a certain trade, what that risk profile looks like, so that you kind of understand where that trade's going. So that's everything with that. Hopefully that's a little helpful. Again, you don't have to adopt any of these definitions yourself. This is just what I have personally done and found it a little bit helpful.